Welcome back. This is part two of a recording devoted to deferred tax. We're still doing the same question as before. We actually solved the question in the previous video. If you didn't watch that video, please do before you go any further with this one, because it's really it's the second part of something we've already done. And if you haven't watched the previous one, you'll be very lost in this video. So let me recall that in the previous recording, we solved this question about incredible cooperation. And we came to the conclusion that the reported tax expense was 45,000 and the effective tax rate was 30,000. So the answer was C. This question is here just in case you need a bit of a reminder. I'm not going to read it. If you need to, just freeze the video, stop the video, read through the question. And I, in this video, want to focus specifically on the follow-on consequences of what we discovered in the previous recording, namely how is everything recorded from a financial statements perspective and how will it play out in the subsequent year. So not really part of the question, but I think an important addition to make you understand what's going on. So if this is something, once again, you want to get right in the exam, do keep watching and let's get solving. Okay, so here we have our classic financial statements template showing assets, equity, liabilities, P&L, and potentially OCI, although we won't really have much need for other comprehensive income in this question at least. So columns for 2022 and 2023, just as to follow on from the data in the question. And to be honest, in this question or in this recording, I will first be using the P&L for 2022, and only then will I shift to 2023 to show you the subsequent year consequences. Now, as we said in the previous video, in the P&L, the income statement for 2022, we should have an element of interest expense, because even though the interest itself is on a cash basis paid in 2023, it does belong to the 2022 cost computation or profit computation. So it's going to enter here as an expense in 2022, and therefore will have an impact on profit. However, because it's not paid as at the end of 2022 yet, what we will also have is that this interest is payable, showing up under the company's liabilities, current liabilities. So it will have a liability of 50,000 towards the bank as at the end of 2022 to actually physically pay the interest. Okay, that's nice and simple. That's nice and clear. And you must appreciate how it is that the income statement at the end of the day balances everything that goes through P&L does have an impact on the computed amount of net profit for the period. So if you've got 50,000 of expenses going through your income statement, that 50,000 creates a drag on net profit. So here I'm going to do this with the negative arrow to show a downward effect, drag on profit. And as you should appreciate from your studies of this topic thus far, anything that goes through net profit, anything that affects income, ultimately will have an impact on equity as well. So over here, I'm going to say retained earnings. And within retained earnings 2022, definitely this 50,000 is going to create a bit of a drag, this interest expense 50. And this is the way in which the balance sheet ultimately balances. You record interest payable as a liability, but you also record an interest expense, which creates a drag on net profit, and that has an impact on equity, which is where net profit ultimately goes to retained earnings. Retained, suggesting that this is what the company pays, so this is after the payment of a dividend, actually. Now, that's not really about deferred tax. Over here, I've got some subsequent lines to record the tax expense. And as you know, the tax expense or the income tax expense in the income statement is composed of two lines, effectively. One is current tax, and the other is deferred tax. Current tax equates to what you have to pay to the tax office, what you've already paid in respect of a period or what you still have to pay. And I'm going to, following from the question, say, well, the amount to be paid to the tax office in respect of the period was taxable income of 200,000 times 30%. And you may recall that we computed this to be 60,000. So that's my current tax expense. And assuming it hasn't been paid to the tax office yet. Now, look, once again, we've got an expense here. So this is another item which creates a drag on net profit, just like the 50,000 before. And as such, it will impact in a negative way our equity, so 60,000 down, because anything that goes as an expense through profits, P&L, has an impact on equity, more specifically retained earnings. And this creates a drag on equity, but we're going to have income tax payable to show that this is an amount of money which we actually owe to the tax office, and we need to settle with the tax office. 60,000 over here, payables appear. So a compensating, offsetting effect, equity down, liabilities up as a result of computing our tax liability. Now, for this deferred tax element, the critical one, I said that because we are expecting to make a tax saving in the next year, we are already accelerating its recognition to 2022 because it's a direct consequence of the interest expense that we will be paying next year as well. But we've included this as a cost here, so we should also include its side effects in the same column 2022. And because it's a saving, I'm going to report it or show it as a negative 15, negative because it goes into the tax expense computation, but it's a saving. So that's why it's a negative, creating an overall tax expense of just 44 in total. Now, this negative 15 also obviously has an impact on the computation of net profit. However, it's a positive one for a change. And as something positive, it will have also a positive effect on equity or retained earnings. So something positive appearing here for a change. And how do you therefore record this from a balance sheet perspective? 50, 50, 60, 60, we've dealt with those, but this positive 15 now would create a mismatch in the balance sheet. Well, the way to do it, because we're looking forward to something positive, is to say we have a deferred tax asset. Assets are valuable things and resources. And if you're looking forward to something positive and you believe you'll be able to gain realize that gain, well, it's an asset which you show on the other side of the balance sheet, so a positive 15 over here, which solves the problem of having a mismatch in the balance sheet totals. Assets up, equity up, because you recorded something which is offsetting an expense in the income statement because you believe you will get this benefit. Okay, so at the end of the day, doing this must have the effect of creating a deferred tax asset within your balance sheet as well. Let me just say, that later, once we settle this interest, obviously cash is going to flow out of asset, interest is going to flow out. If you settle the income tax payable, that will flow out, that will disappear from liabilities, and you'll have a disappearing item of cash over on the asset side. But this deferred asset will be there at the end of the year and wait until the next year when the benefit actually occurs. So let's try to depict what happens in the 2023 financial statements in accordance with what we just discussed on the board. So in the year 2023 over here, we don't have any recognition of interest expense. Although there is an actual cash payment, there is no recognition of the tax expense as such. But because the cash payment is made, let me just say over here that we're going to have cash within our assets, and out of this cash in the year 2023, we have an outflow of interest equal to 50, and that obviously means our previous payable disappears, and this happens at the very end, at the very beginning of the year, January the 1st, 2023. I'm also going to assume that we settle our liability towards the tax office, so we also make a payment of 60 in cash, and that causes the income tax payable to or liability to vanish. What I want to do now is explore the follow-on consequences of recording a deferred tax asset in 2022. So what I'm going to, I guess, imagine, this is not part of the question, is that it is now 2023 and we are once again computing the financial performance of the company in accordance with the same rules as before. And, on the one hand, doing this for financial statements purposes and on the other hand for tax purposes. So we're going to have the company's income statement, just like before, but also its tax return. And I'm going to assume certain things that are not part of the question. For example, I'm going to assume that the company once again will generate the same level of reported earnings before interest and tax. So this will also be the case in 2023, although the question doesn't really say that. It doesn't have to, because it doesn't concern itself with the year 2023. So in the income statement, I'm going to have earnings before interest and tax of 200,000. However, seeing as the interest expense, which is suffered from on a cash basis in 2023, from an income statement perspective or accruals perspective, has already been recognized in the previous year, I can say that EBIT is actually the same as EBT, because we're not going to record the interest expense in 2023 income statement. We already did it in the previous one, so there's no need to kind of duplicate that. However, from the perspective of our tax computations on the right-hand side over here, this 200,000 will very much be a component of taxable income computation. But right now, 2023 is the moment to recognize the interest paid, i.e. 50,000 of interest, to make sure that we compute our tax on a base of 150,000, not 200. So this is our taxable income, and we know we should be applying a tax rate of 30% to this. And 30% of 150 is essentially 15 times 3, so 45, which will need to be paid to the tax office. Remember, in the previous year, it was 60. Now it's 45. Okay, on my left-hand side, I now create a line for tax expense. And as you know, this is composed of two things: current tax and deferred tax. And when it comes to the current tax component, we simply take whatever is paid or payable to the tax office in respect of the year. So 45. Now, the deferred tax component is to do with, previously it was to do with looking forward towards a tax benefit resulting from the fact that we would pay interest in 2023. And you will remember from the previous question that we created a deferred tax asset within the balance sheet to show we are expecting such a benefit. Now that we have already paid interest and have already received the benefit of the tax saving associated with that, there is no further benefit to look forward to. And when we, in a moment, get to the balance sheet view, what you'll see me do is you'll see me derecognize or remove that asset from the balance sheet, because it's only it only plays a role there when we are still looking forward to something. Now that this something has occurred, we have to remove it. We have to write it down or write it off or simply derecognize it. And as a result of having to remove an asset, you're going to have to recognize a cost in the income statement. Just like the creation of the asset was was something positive for the income statement, now it's going to be a reduction. And because we're doing expenses here, a cost, I'm just going to show it as a positive 15, which causes the tax expense overall to be equal to 60. And therefore, our net profit computation yields 200 minus this 60, so it's 140. Please appreciate the effect of adding this 15 over here. What effect does it have on our effective tax rate? Remember, effective tax rate is the relation of tax expense, reported tax expense, 60, to earnings before tax, 200, and 60 divided by 200 is a relationship, I think, of 30%, but let me just check quickly on my calculator, on my phone, which has a calculator in it. So 60 divided by 200, yeah, 0.3, absolutely. So 30%. Even though we didn't pay tax of 60, as a result of this adjustment, we have a nice relationship of 30%, which is the same as the statutory tax rate at which the company pays tax, between tax expense and 200. So we have a match. I really want you to appreciate the logic of doing these deferred tax adjustments. So I'm going to take some extra time to explain this in another way. First of all, I want to create a bit of a table in which I'm going to have a column for 2022, that's the prior year, and 2023. And for both periods, I will want to explore what we did in our income statements, obviously also recollecting the previous one. When it comes to earnings before tax, we have obviously 200 over here in 2023. But if you recall the previous year, it was 200 minus the interest expense of 50,000, so that was 150. Because, as I said just a moment ago, it includes or incorporates interest expense of 50,000. Here it doesn't, even though this is the moment when the interest expense, or the year in which the interest expense was actually paid. The tax computation, and therefore tax computed in the 2 years, was respectively 45 over here, because it incorporates the interest expense, or it was the computation of this 45 incorporated a deduction for the interest paid, whereas in the previous year it was 60, because it didn't incorporate any interest effect. As for tax purposes, interest is tax deductible on a cash basis when it is actually paid. As you can see, this created a temporary mismatch between the way we handled that interest expense from a financial statements point of view and a tax point of view. And the whole role of deferred tax, so to speak, is to reconcile those differences, so that, tax computed goes into the income statement as current tax. But we also have this additional line called deferred tax, which provides an extra component in the tax expense computation. And over here, it was an additional 15 in 2023. 23, an additional expense of 15. However, if you recall from the previous year, we had a negative 15, a negative expense. So something that offset expenses. So lowering the tax expense so that the overall tax expense would be in the 2 years respectively 60 minus 15, so just 45, and over here 45 but plus 15, so as much as 60. And as a result of doing this adjustment in both years, we get our tax expense very much aligned with our accounting profit, our earnings before tax. So when your earnings before tax is 150, your reported tax expense is 45. And that is 30% of the EBT up here. At the same time, or subsequently, this 60 of tax expense, which we have for the year 2023, is also 30% of the earnings before tax for that period, so the 200. So in a way, we are neutralizing, offsetting the effects of the tax rules being different to the accounting rules and making sure that things are aligned here in terms of the effective tax rate. That's the whole purpose of deferred tax. And in a moment, you'll see how that works from a total financial statements perspective. Now, the way I've presented this computation is, I think, the more logical way of doing it for educational purposes. However, for the purposes of the exam, or if you read the curriculum, what you'll see is that this whole topic is talked about in a completely different way, which I don't find as intuitive, but at least for people who are starting out with deferred tax. But let me now show you the sort of the correct way of computing deferred tax. So the proper textbook way, which I don't find as intuitive, and I think what I've done so far will absolutely suffice in the exam. But if you want to really understand how the curriculum talks about deferred tax, what you've got to follow is a certain logic, which involves computing the tax base of an asset or liability and comparing it to its carrying amount. So, as at the 31st of December 2022, that was the first year in the scenario, and subsequently, as at the 31st of December 2023, what we're going to do is compare the carrying amount of the interest payable with its tax base. Now, interest payable is naturally a liability sitting in the financial statements, and in the previous video, I showed you that interest payable being equal to 50,000 at the end of the first year. So that was 50. Well, let's make it 1,000. Because at the end of the year 2022, we already had it accrued, and we still hadn't paid it. We knew we would pay it on the first day of the next year. Then subsequently, at the end of the next year, when it is actually paid, there is no interest payable. Nice and simple. However, from a tax perspective, that interest payable computation didn't really exist, because interest payable appears in the balance sheet, 50,000, because it also at the same time impacts the income statement as an expense. So what we had is the simultaneous appearance of a liability within the balance sheet, and in the income statement, a cost of 50,000. From a double entry point of view, that's what happened. Because in your tax P&L or your tax return, there was no interest expense, there was also no interest liability as at the end of year 2022. So from a tax perspective, there was nothing there. And then it gets paid in 2023, and there is still no liability as such from a tax perspective. So what you will conclude is there was only a temporary difference between the carrying amount of the interest payable and its tax base, it was obviously a temporary difference of 50,000. And I'm saying it's temporary because it then disappeared subsequently. Now, if you're confused by this, don't worry, most people are. And this is nothing to be afraid of. What I really recommend is that when you approach these types of questions, you think about them in the way I was showing you before, from an income statement perspective, rather than this comparison, because you have to learn a lot of rules here, and they're not necessarily going to be very intuitive. Now, when you've got the carrying amount of a liability being higher than its tax base, we call this a deductible temporary difference, implying that there's going to be a saving in the future. And as at the end of the year 2022, so 31st of December 2022, we can compute, as a result of this being deductible, a deferred tax asset. Because if you're looking forward to a deduction in the future, that generates an asset equal to this difference, 50,000, times the tax rate of 30%. So what? 15,000. And that's the asset, deferred tax asset, which we had in the balance sheet when I, in the previous video, showed you the balance sheet, which then on the 31st of December 2023 ceases to exist. That same deferred tax asset should be theoretically computed as the difference between this and this. So 0 this time, obviously times 30% still gives a 0. So the disappearance or the derecognition of an asset. And I told you already that when we derecognize the asset, assets go down, and there is a hit to the income statement, 15,000 there, because of this disappearance or derecognition, and that's something you'll see in the balance sheet in a moment anyway. Now, what are the rules, the generic rules that you should potentially know? So these are the rules for temporary differences. Temporary differences. And when I say temporary differences, what I mean are the temporary differences between the carrying amount of something in the balance sheet versus its tax base or tax amount, so to speak. They're different for assets and liabilities. When it comes to assets, and this wasn't an asset, interest payable is obviously a liability. If the carrying amount of an asset is higher than its tax base, this will be a deferred tax. This will lead to a deferred tax liability. We call such a difference a taxable temporary difference as opposed to deductible. On the other hand, if it's the other way around within assets, so carrying amount is lower than tax base, you're going to have a deductible temporary difference, so a deferred tax asset. Just like here, but was to do with liabilities. And when it does come to liabilities, well, we have at least part of it already written down. We had carrying amount being higher than tax base. So something generally appearing in the financial statements, interest payable, which wouldn't have been there if you were to do a tax-based balance sheet. And that causes a deferred, well, let me use maybe the green color, a deferred tax asset, because the difference is a deductible one. That's what we officially say. However, if it were to be the other way around, if the carrying amount for a liability is the other way around, you have yourself a deferred tax liability. Now, these rules are helpful to remember, but to be honest, I don't think they're necessarily something you have to drive into your brain. it's better if you understand whether a deferred tax asset appears or not by thinking about, hey, am I looking forward to a tax saving in the future as a result of this difference between tax rules and financial reporting rules? Or maybe should I be getting myself ready for additional tax to be paid, in which case you would create a deferred tax liability. And don't worry, in subsequent questions we're going to explore such situations. But let me just say that the differences here in, or this green stuff here, which gives rise to a deferred tax asset, this is as a result of having a deductible temporary difference, which can both be as a result of carrying amount and tax being different on assets or liabilities, but with reverse signs, whereas these blue scenarios here, these were associated with not a deductible, but a taxable temporary difference. Okay. In the next shot, I'm going to show you what happens in the balance sheet, and income statement, and that will be the end of this scenario. Now, in accordance with the computations we did just a moment ago, I know that my current tax for the year 2023 is equal to 44 because it incorporates the tax saving resulting from the payment of interest, which I know I was going to get, or hoping I was going to get, because I knew I was going to pay that interest. And now for the critical item. Because this deferred tax asset has been sitting here within assets since the end of 2022, and now when in 2023 we do manage to realize the tax saving, the thing we were looking forward to and expressing as an asset has finally happened. We've realized the benefit, which means we're no longer looking forward to any further benefits associated with this. It's already happened. It's already materialized. What I need to do is make this deferred tax asset disappear from my balance sheet. Now, just like before, when it appeared, I had something positive within assets and something positive within my income statement. Even though it was shown in brackets, it was actually an offset, a negative expense. So in fact, something positive. Right now, when this disappears, I'm going to show that the disappearance of an asset creates the opposite effect of 15,000, but this is an additional cost, causing the tax expense overall to come in at 60,000. So ultimately, I have two effects. A drag on my net profit of 45, and this is synonymous with the current tax, but also a further drag to my net profit as a result of 15 downwards in the same direction from the deferred tax. And I can, just like before, show these two items over here as impacting equity, 45 and 15. Now, this 15 downward on equity impact has its other side over here within assets. So, in terms of double entries, you reduce assets, reduction to equity. In terms of the additional 45, which appears here, this expense, a drag on equity, well, this is a fresh batch of income tax to be paid to that tax office. So it just creates a fresh portion of income tax payable to the tax office in respect of the new year. The previous amount was already settled. Now we have a new amount which will be settled again when the time comes to pay to the tax office. But the result is as follows. We no longer have any deferred tax or asset. It was only a temporary item.